Good afternoon. Welcome to the City Club of Cleveland. I'm Nelson Weiss, President of the City Club. It's a pleasure to have you all here with us, listening to us, and eventually watching us. Today, I'm pleased to introduce Mrs. Karen N. Horn, President of the Federal Reserve Bank of Cleveland. Mrs. Horn, prior to her presidency of the Federal Reserve in Cleveland, was treasurer of the Bell Telephone Company of Pennsylvania. From 1971 to 1978, she was vice president and economist for the First National Bank of Boston. From 1969 to 1971, Mrs. Horn was an economist for the Board of Governors of the Federal Reserve System in Washington. Mrs. Horn received her BA degree in mathematics from Pomona College in California and her PhD in economics from Johns Hopkins University in Baltimore. Her university teaching affiliations have included Simmons College, Johns Hopkins University, Williams College School of Banking, and the Wharton School, University of Pennsylvania. She currently serves as Vice President at Large with United Way of Cleveland. She served as Director of the T. Rowe Price Prime Reserve Fund and the T. Rowe Price Tax Exempt Money Fund. She's President of the Walnut Street Theater, Director of the Afro-American Historical and Cultural Museum, and Trustee of New England Deaconess Hospital. Mrs. Horn is married. She has one child, 4.5 months old. It's a pleasure to introduce Mrs. Karen N. Horn. Mrs. Horn.
Thank you. It's a pleasure for me to speak to you today. As you know, I'm a relative newcomer to Cleveland, and this is especially nice for me to meet with you in this forum. I suppose that many of you know about many of the activities of the Federal Reserve System. Some of these activities are much like businesses, providing valuable services to depository institutions in the marketplace. Others are supervisory and regulatory in nature, aimed at promoting competition and efficiency in our financial system. But the most important activity of the Federal Reserve System is its conduct of monetary policy. So today I will discuss the rationale behind the monetary policy strategy being employed by the Federal Reserve, as well as the implications of, and dangers to, that strategy in the future. When I'm talking about monetary policy, I'm reminded of the story of the fellow who went on safari to Africa. He was going lion hunting one day, and so he put a bullet in his gun and went to the clearing where he was told he'd find lions. He got to the clearing, and there across the clearing was a lion. So he took aim and fired and missed and thought that his life was over, that the lion would certainly kill him. The lion was crouching to jump. The lion jumped, but jumped too far and missed. So the man was able to run away and go lion hunting another day. The next day, of course, he'd learned quite a bit about this business, and so he stuffed his pockets full of ammunition and went to do some target practice. Practiced and still had some ammunition left, but got much better at his aim, went back to the clearing to hunt the lion. He got to the clearing and there was no lion there. And after a few minutes, he became aware of a noise in the bushes. So he looked into the bushes, and there was the lion practicing shorter jumps. Well, that has a lot of relevance to monetary policy. As we conduct monetary policy, we keep facing a changing environment in which we conduct it, and therefore we must change the kinds of policy, the kinds of ways we implement that policy. I'd like to start today by looking a little bit at history and to bring us to the current monetary policy by reviewing what has happened in the last about 15 years in the economy. So that takes us back to the late 60s when our economy was fighting wars on two fronts, Vietnam and poverty. This is truly a classical economic dilemma. Our society wanted more guns and more butter, and against the advice of most economists, they wanted to do it without raising taxes to pay for them. For a while, we did have more of both guns and butter. but it didn't last. As the demand for output exceeded the maximum our economy could produce, upward price and wage pressures were generated. It was then that the inflationary momentum, the inflation spiral of the 1970s began in earnest. Remedial monetary and fiscal policies were put into place in 1969, and the recession late that year into 1970 was the first recession in almost 10 years. With this recession came a slowing of inflation, but at the end of the recession, consumer prices were still growing faster than after the previous post-World War II recessions. The expansionary economic policies of the early 1970s were designed to lift the economy out of recession, but they restarted the price spiral at still higher rates, and the sorry sequence of the 1970s began to unfold. Policymakers were well aware of this gathering inflationary momentum and tried to deal with it with comprehensive wage and price controls imposed in August 1971. Although this program seemed successful at first, peacetime controls cannot halt a rise in prices and wages created by expansionary economic policies. During the ensuing 2 years, the wage and price controls were overwhelmed by inflation, the oil embargo, and a series of crop shortfalls. When controls were dismantled in 1974, inflation was running at still a higher rate than when they were imposed. The recession of 1974 and 1979 was severe, at that time the most severe by far of the post-World War II recessions. For our purposes today, it is enough to note that at its conclusion, prices and wages were still growing faster than they were at the end of the 1970 recession. That is, even though our economy had experienced 2 recessions and the imposition of price and wage controls during this 5-year span, inflation was higher and still rising. It should come as no surprise that inflationary expectations became firmly fixed in the minds of the American public. The shift in the portfolios that households and firms were holding were towards debt finance and real estate and other tangible assets. This was evidence that the American public expected continued inflation and sought to shield themselves from it. Unfortunately, policymakers failed to deal with the implications of these changes. Of course, with the advantage of perfect hindsight, it is possible to conclude that even though policymakers were acting in the best interest of the American public, the information they used to set monetary and fiscal policies was incomplete. There were dramatic changes occurring in our economy in the 1970s. Lagging investment and productivity turned out to be not just the temporary result of a recession, but the new and ongoing structural characteristics of our economic performance. As I've suggested earlier, however, probably the biggest change was the increasing prevalence of expectations that high and accelerating inflation had become the American way. Repeated failure to deal with inflation all but forced consumers and businessmen, savers and borrowers alike, to react to the expectation that future inflation would be higher than present inflation. Workers and management negotiated contracts where wage increases were predicated upon the expectation that future price increases would be adequate to foot the bill. Fiscal and monetary policy were counted upon to continue to finance the inflation, and consumers faced with the shrinking value of the dollar purchased homes, secure in the expectation that prices would be 10, 25, or even 50% higher in a year or two. Artifacts and trinkets of bygone times became collector's items, and markets sprang up to organize the exchange of these new stores of value. Eventually, the expectation of future inflation came to the financial markets. Investors built substantial inflation premiums into the interest rate structure. Since 1970, the Federal Reserve has had targets for the growth of money. These targets were thought to be consistent with its ultimate goals for production, employment, real growth, and inflation. For after all, as much as I will be talking about interest rates and the money supply today, what the Federal Reserve is really after is creating an economic environment that is healthy and that permits growth of economic activity and productivity and high employment. The Federal Reserve attempted to achieve its money growth targets by targeting the federal funds rate. The federal funds rate is the interest rate banks charge to each other for overnight loans. And targeting this rate would then influence other short-term interest rates. When money was growing faster than the desired rate, the federal funds rate was increased. And when money was growing slower than the desired rate, the federal funds rate was lowered. This strategy worked reasonably well when inflation was low and before inflationary expectations became so deeply embedded into decision-making. But since inflation premiums are one component of interest rates, the Federal Reserve in the late 70s, had no sure way of knowing what the size of the inflation premiums were, and therefore it was difficult to determine what the appropriate level of the Fed funds rate should be. Again, with the benefit of perfect hindsight, it now appears that the federal funds rate and probably the entire structure of interest rates was kept too low in 1977 and 1978. Not only did money grow too fast to keep inflation in check, it grew fast enough to push inflation up again and set off another round of inflation-induced decisions in the late 1970s. In 1979, the Federal Reserve had come to realize that its procedure of targeting interest rates was inadequate to control the money supply and inflation. Thus, in October of that year, the Federal Reserve announced a change in the procedures used to implement monetary policy. Instead of targeting the federal funds rate, the price of bank reserves, as a means of controlling money growth and hence inflation, the Federal Reserve decided to begin to control the amount of reserves directly, and that translated into the money supply. With this change, we gave up much of whatever direct influence we had on short-term interest rates and began to target the growth of the money supply. M1, M2, M3, and bank credit are some of the definitions of the money supply. The Fed then set about slowly decelerating the growth of money as a means of wringing inflation out of the economy over time. The money supply measures that I've referred to measure the dollar amounts of various highly liquid assets, assets that can be used for transactions purposes or can be quickly transferred into transactions balances. So, for example, M1, the narrow definition of the money supply, is the sum of cash, currency, traveler's checks, and all checkable deposits available on demand. M2 starts with M1 and then adds to it some other highly liquid assets, such as savings and small time deposits, overnight repurchase agreements in Eurodollars, and money market mutual fund balances. The other definitions then are subsequently broader and are types of money that are somewhat less liquid but still very liquid. Research has shown that these aggregates, especially M1, are closely related over long periods of time to economic activity. First, to total spending, and through it, they are the link to inflation. Now, I briefly reviewed this recent history of our economy for two reasons. First, to suggest that inflation arose gradually over a long period of time. Second, to argue that excessive money growth over long periods of time is necessary for inflation to persist. Therefore, an effective and credible disinflation strategy demands that the growth rate of money be reduced persistently and permanently. But because inflation had become so much a part of the American public's way of thinking in life, the deceleration could not proceed too quickly without imposing large costs on our society. This is the philosophy the Federal Reserve has followed since late 1979. and it has produced some significant and noteworthy progress in decelerating the price spiral. In fact, inflation rates have fallen much faster than any of us expected. From the peak rates of increase in consumer prices of 12 to 15% to an annual rate of under 5% for the last 18 months. Disinflation has now begun to affect the cost side as well. Wages in the non-farm business sector are now rising at an annual rate of about 6%. That's about 1/3 less than during 1979. As we here in Cleveland are so painfully aware, some other things have happened as well. Some of these are the inevitable result of any credible disinflation strategy. Others are the result of structural changes sweeping through our economy. Real GNP, that is inflation-adjusted GNP, is currently at about the same level it was at the end of 1979, some 3 years ago. The unemployment rate is at a post-war high of 10.4%. Industrial production is down 10% from its 1979 levels. There is serious financial distress in most parts of our own economy and throughout the world as well. The Federal Reserve is acutely aware of these costs. If, as I believe, these costs are in part the inevitable results of any effective disinflation policy and partly the result of structural change, they should not become the excuse for abandoning policy. Indeed, perhaps the most painful of all the lessons of the 1970s is that we paid the costs of recession twice and still did not create a less inflationary environment. By failing to carry through then, the costs of dealing with inflation in some future time were greatly escalated. Consequently, the Federal Reserve is determined to continue its policy of anti-inflation. There has been much publicity and speculation lately about some temporary changes which we've made in our money control procedures. I would emphasize that these changes are only changes in the implementation of monetary policy. They are not changes in the disinflation goals of that policy. These changes were made necessary by two events. One is the maturing all savers certificates, which heavily affected the M1 aggregate in the months of October and November. Some $30 billion of the funds held in this instrument, of the $42 billion of the funds held in this instrument, matured in the month of October. The Federal Reserve does not know how much of these maturing certificates will be deposited temporarily in demand deposit or now accounts. Those two accounts are part of M1, while savers decide to reinvest the funds. Thus, for a while, certainly in October and November, and perhaps in December as well, the funds may shift from funds that were part of M2 into M1, and they then may shift out perhaps back into M2, or perhaps into some other measure of the money supply, or some kind of investment that's not counted in the money supply at all. In any case, during the months of October and November, and perhaps December as well, M1 is a misleading indicator of monetary policy, and so the Federal Reserve must not focus solely on M1. The second event which caused this technical change is the introduction of the new deposit accounts by banks and S&Ls in December. The details of this account may still change, but it is designed to allow banks and S&Ls to compete better with the money market mutual funds, and eventually it may even draw funds out of other financial assets. In any event, the new account will obscure movements in M1 beginning in December and in the opening months of next year. As a result of these difficulties, and at least until we are able to interpret movements in M1, the Federal Reserve has decided to place heavier emphasis on M2. This aggregate is broader. It encompasses about 3 times as large a volume of financial assets as does M1, and will be less heavily influenced by the all savers accounts and the new account. In addition, the Federal Reserve will keep an eye on financial and economic activity, as it always does, to help guide policy. This change is a technical change in the implementation of monetary policy. It is a practical response to a practical problem, and it has no bearing on the Federal Reserve's resolve to pursue its disinflationary goals. I would like to close my remarks today by looking at some of the problems which we face today and in 1983. Some of these problems will have a critical bearing on monetary policy. They will determine whether we will succeed in creating the basis for a sound recovery, or whether we will repeat the errors of the 1970s, attempting to force a recovery regardless of the longer-term inflationary consequences. Obviously, the recovery, which is probably now getting underway, must be encouraged. The sharp decline in interest rates, which has occurred since July, largely in response to reduced inflation, is a most hopeful development. As I look ahead over the next year, I see several critical questions. For monetary policy, the first problem will be to get a clearer reading of the effect of the new account upon the behavior of the monetary aggregates. For the conduct of monetary policy, the Federal Reserve will have to accumulate additional evidence on the use of the account and its impact upon the aggregates which we seek to control. Eventually, additional legislation or regulatory changes may be required. So the concept of money supply must be redefined after some months have passed, and then the targeting of the appropriate rates of growth for that newly designed money supply will be problems we will face next year. A second problem for 1983 may be the need to allow interest rates to rise. As I have argued earlier, money supply growth must be held down. A failure to do so will, as the experience of the 1960s and 1970s has demonstrated, help recreate the very problems that we've been struggling to solve. There are, moreover, several factors which may make this a more difficult task than it normally is in the first year or two of an economic recovery. One is the federal government budget deficit. The federal deficit is not so much of a problem now as it will be by 1983 and 84. Simply put, the deficit must be financed by borrowing in the capital markets. That is not a great problem when the economy lies in deep recession because private credit demands are weak. As the economy recovers, however, private credit demands will strengthen. Colliding with the $150 to $200 billion federal borrowing, which is now being projected for 1983, and perhaps at that annual rate in 1984 and beyond. Over the period, we must either curb the rise in federal outlays, increase taxes, or expect to see the interest rates driven sharply upwards by the collision in this demand for loanable funds in the credit markets. Another problem is the fragility of public confidence in public policy. It is encouraging that the credibility of the Federal Reserve has been restored. We may well ask, however, how long this will persist in the face of a never-ending string of high federal deficits. These suggest strong pressures for the Federal Reserve to abandon its goal of non-inflationary money supply growth and underwrite the federal deficits. The third problem, which I foresee, follows directly from the second. Should interest rates rise early in the economic recovery, Congress may put substantial pressure on the Federal Reserve to abandon its disinflationary goal. Currently, there is talk in Congress of forcing the Federal Reserve to target interest rates. The dangers here are evident from the history that I have reviewed. Recall the lesson of the 1970s. Low interest rates are not consistent with non-inflationary money growth if inflation is high and expected to increase further. Congress may well reserve all discretionary interest rate actions for itself, thereby putting the disinflation strategy at the mercy of political pressures. I would summarize my message today in the following way. We are in the midst of dealing with the accumulated problems of a couple of decades. We may choose to attribute our present problems to past policy errors, to sudden and unforeseen changes in our own economy, and to the vagaries of events overseas, or to a whole host of factors. We allowed an inflationary thrust to develop in the American economy, and through overly permissive monetary and fiscal policies, we allowed it to accelerate. We've made great progress in restoring the conditions required for greater price stability. This progress cannot endure without a monetary policy that reduces the growth of money permanently to non-inflationary rates. The long-run health of our economy can only be restored through restoring our belief in the ability and the willingness of economic policymakers to pursue that goal persistently. The commitment of all sectors in the economy is necessary for a permanent return to a low inflation environment and an environment of economic health and well-being. Thank you.
Thank you very much, Mrs. Horn. Today at the City Club, we are listening to Mrs. Karen N. Horn, President of the Federal Reserve Bank of Cleveland. In just a moment, we'll turn to our question period, but first some announcements. Many of you in our audience today, both here in the Holland House and those in our radio and TV audience, across the years have supported our Forum Foundation with year-end tax-deductible gifts. This kind of support enables us to maintain the high level of this weekly Forum series. I know from periodically we mention this same point as we make our way through the year, but it is crucial to the success of the outstanding programs that we have and that today's program typifies. Right now, as we come to the end of the year, it's a good time to write your check and to send your donation to continue these programs to the City Club Forum Foundation, care of the City Club, Holland House, Cleveland, 44114. Each gift will be promptly and gratefully acknowledged. Today, as always, we have with us students who are participating in our Living Seminars program, which we sponsor in cooperation with the Cleveland Board of Education and Cuyahoga Community College. Today, we have with us students from the following area high schools: Lincoln West, Glenville, South, Olmsted Falls, Warrensville, Benedictine, Normandy, and Charles F. Bush. I'd appreciate it if they would stand to receive our welcome. Thank you. They will be meeting with Mrs. Horn for their own seminar right after our forum ends today. Next week, because of the Thanksgiving holiday, we shall have no forum here in the Holland House, but we shall have our radio and TV broadcasts at their usual times as we present. I hope the mayor didn't and isn't going to listen to this announcement. I'll try again. As we present Mayor George Voinovich. In his address to a special forum which he gave earlier this fall, which actually has never before been broadcast, in which he spoke on the new federalism and its impact on the cities. I was there, and it was an outstanding talk, and I hope many will listen. Be sure to listen to this very timely address. 2 weeks from today, our speaker will be Jan Nowak, an internationally known author and broadcaster from Poland, who will be speaking on the current solidarity movement in his country. I call to your attention in connection with Mr. Nowak the major review of his book called Courier from Warsaw, which was published in the New York Times Book Review section on October 31st, an outstanding review, and I anticipate that talk to be as outstanding as his book appears to be as well. You may make your reservations today for this important forum. Now for our questions for Mrs. Horn. We have 2 microphones, one with Alan Davis over here, the other with Bob Conrad here. Please raise your hand to be recognized. Mrs. Horn, first question.
I'm Sam Walpert, And I thought the Federal Reserve has a dual policy. One is to control inflation, and the other is to have a prosperous economy. Now, in terms of your mention in your talk of inflation and unemployment, I think the mention of inflation was about 100 times the number of times you mentioned unemployment. Unemployed people are under deep suffering. They have a real problem. Cleveland is a capital goods town. It is important for our economy and our people to have low interest rates. And I think what I can't understand is, don't you understand that? And why do you so strictly monetarious?
As I had mentioned in my speech, although I'm talking about things like inflation and interest rates and money supply, the ultimate goal of the Federal Reserve is, in fact, the healthy economy and the lower rates of unemployment. We have arrived at the place where we are because we have created, economic policymakers and events have created a set of circumstances that did not allow a healthy economy to function. And as you point out, it's particularly important in an area like Cleveland where we have capital-intensive industries, because the inflation that occurred over the 1970s is particularly damaging to us here, because what it did was force business decisions of the kinds of investments that had very short-term payouts. And so our industries were not able to make decisions that had longer-term payouts, which would keep them competitive with their sister industries around the country and around the world. So we were particularly damaged by the inflationary policy. The damage hits us in a second way from an inflationary policy in that expected inflations are what makes the inflation premium that's built into interest rates. So that if you are loaning your money today that's due a year from now, you'd want some kind of real return, maybe 2 or 3%. You'd want also to have that money, when it was returned to you, pay you a high enough rate of interest to compensate you for the inflation that had occurred in that period. So if it was 5% inflation, you'd now be asking for 3% plus 5% or an 8% rate of return. Plus, you'd also need a rate of return to compensate you for the amount of risk in the investment. And let's just say in this case that's going to be 2%. So that would get you up to an interest rate of 10%. That 10% interest rate would be 5% if inflation was expected to be 0 in the next year. So that this highly inflationary environment is what has led us to the high interest rates which the marketplace demands for people to give up money for a period of time.
You also mentioned in your talk that it took a long period of time for inflation to build up as it did. What I believe now is that if interest rates kept coming down, you would not get a return to inflation so fast. In other words, really the question is, we could have lower interest rates if the feds will increase the money supply a little bit. And I think now's the appropriate time to do that.
Of course, the interaction between interest rates and the money supply is not perfect, which is why the Fed gave up the targeting of the interest rates. But it is certainly the case that in a weak economy, as we're experiencing now, there is less pressure on interest rates by financial markets. And so that is a time when Federal Reserve policy can, as it is now doing, exceed the targets for the money supply that have been set for it for this year. So that for technical reasons that I referred to in my speech, we're exceeding our targets. But in addition, in response to the very weak economy, the Federal Reserve has said that for an interim period, it will tolerate growth of the monetary aggregates above the top part of its range. And we can do that when the economy is this weak, precisely because the pressures are not there to reignite inflation. As I then went on to mention, In 1983, presuming the recovery comes along track, we may have to reconsider this policy of allowing the money supply aggregates to be somewhat above their target ranges. The other thing I'd say in response to your question is you talked about how long it took to build up inflation, and then that implies, and I agree with you, it implies a period of considerable length over which we must take inflation out of the economy. And the Federal Reserve's response to that is to say, once we do choose the monetary aggregates, we will lower those targets gradually over time, not all at once. We won't pull that money supply growth down to a disinflationary rate all at once. So that in October '79, when we began to target the money supply directly, we set a target range of growth for M1, for example, to be between 3.5% and 6.5%. The following year, we said between 3% and 6%, and this year we say between 2.5% and 5.5%. So each subsequent year, we have been taking a 0.5 percentage point out of each bar of the target, and thereby gradually lowering the way the money supply grows. That is, we believe, consistent with dealing over a long period of time with inflation that built up over a long period of time, and that therefore supporting the highest level of economic activity that we can, consistent with the disinflationary strategy.
Dr. Horn, you said in your talk and just now that the Federal Reserve Board attempted and did control the supply of money. I have two questions. One is, how did it control the supply of money? And two, is it at all likely that they might think it'd be necessary to do this again?
The answer to your first question, how we control the supply of money, is we have a so-called open market operations desk, and thus the committee in the Federal Reserve that sets money supply policy, monetary policy, is called the Federal Open Market Committee. The Federal Open Market Committee meets 8 times a year and sends instructions to this open market desk. The open market desk has access to our vaults, which have cash and securities in them. If our instructions to that desk are, go out and sell the securities from our vault, when they do that, we take securities that were not in the private sector, we sell them in the open capital markets and get back cash. That cash goes into our vault and then comes out of the money supply. So if we sell securities, we're decreasing the money supply. If, on the other hand, we want to increase the money supply, we go with cash from our vaults and buy securities on the open market, take those securities back into our vaults, and now the money supply is increased. So that is the mechanism, and it's commonly referred to as open market operations. Now, we are continuing to do this, but we are no longer able to do it primarily based on the M1 definition of the money supply, the narrow definition of money, which is cash plus demand, anything you can write a check on, essentially. Because of the technical problems, we're now having to conduct this kind of operation based on a different measure of the money supply, which is M2, which starts with M1 and then adds some savings accounts and the money market mutual funds in it. So we are still very much targeting the money supply in conducting our open market operations. The challenge for next year will be to what in some sense the challenge is every year for us is to continually redefine the money supply. In days a decade ago, when financial instruments weren't changing very fast, you could, if you really knew what the money supply was one year, it would probably be the same thing the next year. But now we have all kinds of new kinds of accounts. The growth of the money market funds, for example. When they became something that was widely used by the population, should they be in M1, which is cash and accounts you can write a check on, or should they be in M2, which isn't quite so liquid, but still very liquid? Well, of course, you can write a check on a money market fund, and that might cause you to want to put it in the narrow definition of the money supply. But even though you can write a check on a money market fund account, in fact, people write relatively few checks on those accounts. So in fact, those accounts are used largely as a savings vehicle. And based on that kind of study, we decided not to put them into M1, but to put them into M2. And then subsequent examples of that are the development of NOW accounts. Are they part of M1 or M2? And if they are used very much like checking or demand deposits accounts, and so they got placed in M1. Now we come to the next problems of all the new accounts that I discussed in my talk are being developed. So we continue to target monetary aggregates, and we're targeting M2 because it's less affected by all of these changes. But as next year goes forward, we will be continually redefining what the money supply is so that we'll be targeting the appropriate target, which is that is very closely related to transaction spending in the economy.
I'd like to ask a question, have you take a little broader look at the Fed and tell me, how do you resolve these political questions in the boardroom, the compromise that has to be met? How does the Fed maintain its independence? And how do you resist the political pressure which has the inflationary bias built in?
It probably won't surprise you to hear that we resolve these kinds of issues in a way that any meeting would do so. We talk about the environment, the economic environment in which we operate. We talk about the goals we're trying to achieve and the various alternatives to achieve those goals. And then it's a meeting of, well, it's actually a meeting of 19 people plus their staff, even though there are only 12 voting members. And the vote rotates through the 19 members of the committee. So we have the discussions about the economic environment and the alternatives. In that forum, we also, through the Federal Reserve Board in Washington, have the 7 governors who sit there, who are 7 of the 12 voting members of the Open Market Committee. Those governors are frequently down on Capitol Hill testifying, and of course, Chairman Volcker gets a great deal of publicity when he testifies on twice a year on a major review of monetary policy, and then in between times on some specific kinds of subjects. In addition to that, some of the rest of us in the Federal Reserve System are called on to testify from time to time. So there's no way in which we resolve this, but there are a continuing broad set of actions that we are always undertaking to deal with the fact that the lion is practicing shorter jumps.
I'd like to ask you what you would like to see the President and Congress do in order to get the economy going again. In your talk, one of the things you talked about was reducing the size of the deficit. How would you like to see that deficit get reduced? Now, typically people will say cut the defense budget. That seems to be everybody's target. If you were to say you couldn't make meaningful cuts in the Defense Department for national security purposes, in other words, you had to go other areas, raising taxes or cutting spending, which among those two would be preferable, and what other things would you like to see Congress and the President do, or also what would really be bad if they were to do?
Well, I answered the second part of your question first, and you gave this answer, in fact, as part of your question, is what would really be bad is if that deficit didn't get reduced. What we in the Federal Reserve really need is those aggregate credit demands to be of a volume that doesn't force interest rates up. And so it's very important to us that the federal raising of money does not crowd out the private sector from raising the money it has to raise in order to grow and make an economic recovery. Now, I'll be a little less specific in my answer to the first part of your question, because the Federal Reserve stopped short of recommending the the ways in which that deficit should be reduced. We take a very strong position on the reduction of the deficit because that's what we need to conduct a coordinated monetary policy that's disinflationary. We need a fiscal policy that is not inflationary. But the whole range of the ways that can be accomplished are some of the ones you mentioned, from dealing with defense spending or overall government spending issues, to raising taxes, or if it works, to lowering tax rates if what that does is get the economy started again and actually raises tax revenues. Because, of course, the deficit is the difference between federal spending and federal receipts, which are the tax revenues. So we stop short of recommending specific kinds of government policies, and we're very much in favor of policies that work in reducing the deficit.
Mrs. Horn, critics of the Fed thinks it's time for some reforms, and it hasn't changed much since it was first constituted the early part of this century. Probably draw the parallel, the Board of Governors like the College of Cardinals, Paul Volcker's a Pope, and that makes you an Archbishop. I'm not asking you to criticize your Pope, but where would you like to see some changes? For instance, correct me, an appointment to the board is for 14 years, correct?
That's correct.
And a few other things. And also, at the highest level of banking, it's white and male. You see any changes coming?
Well, I guess there's been a small change in that area. The Federal Reserve System was established in 1913 in response to a number of problems at that time, and those problems included that money across space did not move freely. I sometimes like to look at monetary policy as guaranteeing the value of money across time. That is, next year money needs to be worth almost as much as it was worth this year. But when the Federal Reserve System started, that was not the problem so much as it was the value of money across space. If you were traveling to New York from Cleveland and you took with you a note from a bank in Cleveland worth $100, when you got to New York, you wouldn't get $100 for that. And it would be discounted substantially depending on where you were, in what bank you were getting New York currency. And you could lose 50% of the value in just making that transition across space. So the Federal Reserve was established in part in response to those kinds of problems, and then the monetary policy problem has developed over the period of time we've been in place. We were also established with 12 district banks around the country. Cleveland is the center, the main office of the 4th Federal Reserve District. And that was in part to deal with this space problem, and in part it was a compromise exacted by William Jennings Bryan, who wanted to be sure that the financial clout was not centralized, and that it wasn't in Washington. He thought it was going to be centralized, but Wall Street. So the way we've, and over time we've developed in that there used to be other as monetary policy started to become important, the makeup of the Open Market Committee has changed over time. Until now it consists of the 7 governors in Washington with 14-year terms, appointed by the President and confirmed by the Senate, with a chairman named for a 4-year term by the President, and then the remaining 5 of the 12 members of the Open Market Committee are 5 of the Reserve Bank presidents on a rotating basis. We've evolved to that position because the presidents are not appointed, the 12 district presidents are not appointed by the President of the United States or confirmed by the Senate, but are in fact appointed by their own boards of directors in their district, and then that appointment is approved by the Federal Reserve Board of Governors in Washington. And that is, so the presidents are less politically, or less sensitive to short-term political pressures than the governors are, although, of course, the 14-year terms are intended to insulate the governors from political pressures. Now, of course, the ultimate political pressure on the Fed comes not from appointing and confirming, but comes from the fact that the Federal Reserve Act of 1913 is an act of Congress, and Congress can do anything it wants with that act if it can just get a majority of its members to agree on what it wants. So we've arrived where we are, I suppose I would say, in a heuristic manner. We started with the problems of 1913, and there have been changes to the system that have occurred over time. And while I'm sure the system isn't perfect, it has within it the flexibility to have change as the demands on it have changed, and to be less now involved in the so-called payments mechanism, the money over space problem, and has developed the Open Market Committee to where it is a focal point of the Federal Reserve's activities. So I think we have institutionally a structure that works very well. Now, the kinds of things that are being proposed to change us may indeed get to the point in the next couple of years where there's specific institutional proposals. For example, the makeup of the Open Market Committee. I happen to be a strong proponent of the current makeup, since it is a committee that it's conducting long-term policy, and it isn't so politically sensitive as other members, new members of that committee might be. So we may get to the question of institutional changes. The first thrust of the changes that's being suggested for the Federal Reserve, however, aren't to change the institution, but to change the way in which we conduct monetary policy, so that in this session of Congress there was a bill introduced that would have required us to target interest rates. Then it would have taken the next step, or one of the bills, either the House or Senate version, would have had the President of the United States comment on those targets. From the other side, we're going to be facing a study from the Treasury Department, who is very much against targeting interest rates, but wants the money supply targeted with a control mechanism that allows for less short-run fluctuations in the money. So we're being attacked from opposite sides of the opinion spectrum of how monetary policy should be conducted. As I say, that might eventually lead to institutional arguments, but I think those are the goals of the kinds of Washington criticisms that the Federal Reserve is undergoing. They're really criticizing the ultimate philosophy of policy.
In the past few years, it's been sort of a recurring issue through Congress to exert more influence on the Federal Reserve System through legislation or indirect methods. You've been touching on this throughout your talk, but I'd like you to expand a little bit more on your attitude about congressional influence.
Be delighted to. Monetary policy is a long-run policy tool. Stop and start growth in the money supply is very damaging to the economy, and that's because if you study the effect of monetary policy on the economy, you find that the lags are long and variable. Economists agree on very few things, but one thing they agree on is that the lags associated with monetary policy are long, variable, and somewhat unpredictable. So if we change a monetary policy today, a money supply policy, it may affect the rate of growth in the underlying economy 6, 9 months down the road, maybe 12 months down the road. Its effect on inflation maybe 2, 3, or 4 years down the road. So if we make a short-run shift in money supply policy, we don't know when it's going to hit the economy and whether that's going to be the right time. So it's a long-run policy tool. On the other hand, there are other kinds of economic policy tools which have about them the ability to deal with the short-term fluctuations in the economy. For example, fiscal policy, that is the whole tax and spending policy. You can make changes in taxes, you can make changes in government spending, and you know that that's going to hit the economy right away, if they're written in such a way to hit the economy right away. The other kind of government policy that I never like to leave out of a list of economic policies is regulatory policy. And that's been a policy that's been highly inflationary for us over this period of time. It's something I didn't talk about in my speech. So we have a long-run policy tool, and that was the reason that the Federal Reserve is insulated by its structure, that Congress insulated it by its structure from the short-run political, day-to-day political pressures. There are a whole group of short-run policy tools which can be brought to bear on those, which isn't to say that monetary policy should ignore what's happening in the economy today. And we talked earlier about the fact that the Federal Reserve says when the economy's this weak, the inflation problem is not, there isn't so much pressure for inflation, and we can, on a temporary basis, allow money to grow a little faster than our targets. But the important distinction between the long-term and short-term goals of economic policy is really best maintained by having long-run policy run by a branch of government that is able to focus on the long-run goals. And that's why I think a challenge to the independence of the Federal Reserve System is just would have serious consequences for our economy.
I think we have time for one short question and answer.
Mrs. Horn, soon Uncle Sam will be withholding money we get on our savings accounts and dividends. Were you in favor of this, and will it be any measurable change in our economy because of this move?
The Federal Reserve doesn't take a position on that, but of course, to the extent that changes the way financial flows happen in our economy, that is part of the problem we face when we define the money supply. But in running monetary policy, if we can adjust to the kinds of federal policies, an example of which you've just given, then as long as they don't increase the deficit, we can seek to understand financial flows and define money in a way to be able to continue to conduct our policy in a way to permit the long-run health of the economy.
Thank you very, very much, Mrs. Horn. Thank you, ladies and gentlemen. Our forum is adjourned.